Joining us right now, Milind Sarwate on the show, and we also have Manoj Menon joining in from ICICI Securities. Gentlemen, morning. Good to have you on the show. Milind, if I could kickstart the discussion with you, how do you see the retail consolidation change the industry's landscape? And what would it really do to the return profile in the medium to long term? And what sort of risk could it really pose for other FMCG players now that clearly Reliance Retail is the big giant in the market at the top #1 slot?
Okay, so good morning and thanks for having me on the show. You asked many questions, so let me attempt answering them one by one. Firstly, I agree that Reliance is the elephant in the room now because of its success in other fields. Its entry in FMCG is something which the sector will have to sit up and take note. But we have to keep in mind a few things. Firstly, FMCG is not only about distribution, it's also about brand creation and brand sustenance. And Reliance, while it now has a successful consumer brand called Jio, its success in other walks of the FMCG field has not yet been registered. Not to say that they won't do it, but it is yet unproven. Secondly, I feel that the size of Reliance in terms of the overall FMCG market, we need to realize that FMCG may be a 4 to 5 lakh crore industry. Within that, modern retail is anywhere between, using some crude numbers because of COVID has vitiated some data, as also we may not always get the best possible data. So if you look at that 10 to 15%, within that Reliance Retail and the Future Group combined may have a share of maybe about 40%. So that gives them a share in FMCG of anywhere between 6 to 8%. There have been some reports calling it at about 10%, which I feel is a little exaggerated. So distribution itself cannot be a share of the FMCG market because these brands, finally, Reliance will sell HUL products in its stores. It will sell some of its own products for sure, but those products as of now are small. I think the share of own brands, private labels or in-house brands, as you may call them, that share has been pretty low and it may be 0.5 to 1% of the overall FMCG market. And apart from Reliance, Birlas have tried it, Spencer's have tried it. And there are, world over, retail chains do attempt to get into in-house brands, but I cannot think of anybody who has built a successful FMCG brand. So I see two challenges. One challenge about the distribution of Reliance Retail being still dependent upon the FMCG sector. And secondly, creating their own brands and competing with the FMCG players as a player itself. On both these, I see issues, and there are certain positives. So maybe later on in the show, I can elucidate on those positives of Reliance's entry.
Sure, I'll come to that in just a bit. Manoj, if I could get you in on the discussion, Reliance Retail is clearly now the big giant in the top grocery retailers, especially after its merger with the Future Group. It is clearly going to become the largest consumer-based retailer that we have right now. What does it mean for competition in the industry and other listed players like a DMart, for instance?
Okay. Hi. Good morning. So three things actually. The first is, what is the impact of the industry consolidation, on the retailer? But the simple answer here is that the market size is fairly large. So to that extent, there is opportunity and headroom for everyone to grow. So it's really not a negative as such, for DMart, specifically to ask that question in that perspective. So that's point number one. Point number two, there are again two facets to, the business model which we are discussing currently. One is the modern trade, and second is the digitization of the Kirana, that vertical. Now, again, 2 points to highlight here. From an FMCG perspective, and that too in a country like India, where the top 3 brands, if you take any large category, particularly in FMCG, belongs to, basically 80% of the market actually belongs to the top 3 players. So essentially, it's a very consolidated industry, what we are talking about. What it essentially means that the negotiation power, on the table between two parties, is equally split between the retailer as well as the FMCG brand itself. To give you an example, no modern trade player, or a digitized kirana sort of a player can realistically try to, sell a toothpaste without really having Colgate on the shelf because, like it or not, they have 55% market share. The same thing applies for a shampoo. The same thing applies for a soap, for a detergent. So a lot of the, categories in FMCG are very highly consolidated. Having said that, interestingly, most of the listed players, across the spectrum in FMCG, are market leaders in their respective categories. So realistically speaking, we don't really see a risk to the listed space. But yes, the number 3, 4, 5, the tail brands in most categories, might actually have an issue.
Sure. Milind, to the point that you were earlier making, and clearly Reliance Retail has its own brands as well. Do you think this is going to in any which way reduce the shelf space for other FMCG pure play brands by any chance? And the 3 points that you wanted to make about Reliance Retail as well, go ahead on that.
Firstly, I feel that a retail organization will want to maximize the throughput. And it will be suicidal for any retail player to say that I will keep only my brands and not the other FMCG players' brands. And I think Manoj also rightly pointed out that if you are wanting to sell toothpaste in your retail store, you cannot say that I will not keep Colgate. It will take quite a while, several years for Reliance to build its own brands, which and therefore it does not need any other brands. I don't see that happening in foreseeable future. I don't think even Reliance is intending to have it that way. Now, coming to what positives this move will create for the sector. Firstly, I feel that the way Reliance intends to spread in the Kirana stores through the JioMart, etc., I feel it will end up increasing the penetration of organized branded retail distribution of FMCG products. As you know, most FMCG companies keep gaining every year new consumers, new recruitment as it is called in consumer. So that recruitment of new consumers from the unbranded, unorganized space, I think that will go up because Reliance will clearly, with its connectivity, it will be able to reach far deeper in the country. This penetration may even come at a lower cost than what it is happening today for the FMCG sector. So I see distribution triggered by Reliance as a boon to FMCG players. Again, Manoj was dead right when he said that the top 2 or 3 people, brands in each category will gain. They will gain disproportionately if the penetration goes up. That's the first point. The second point is, I feel that the whole connectivity, the mobile revolution in the country, and the 5G and the other initiatives that we are seeing, I feel it will increase the power of the general trade. In India, when we speak of modern trade, we overhype modern trade and we ignore the big monolith that is the general trade. As of today, general trade would be anywhere between 85 to 88% of the country's FMCG distribution. And I think that sector was typically organized through like a mom and pop shop. It was not following modern management practices. It was not following modern analytical processes which computing and mobile computing enables. I see with GeoTrade and the other initiatives which FMCG players are launching, I think we will see a much more robust and much more informed and much more wise general trade in the market. And I feel that also will help the FMCG sector to grow significantly. The third point I would make is that we are discussing obviously the listed space today, but I feel that the listed space in FMCG has tended to become predictable. The entrepreneurial drive with which companies were created and then they were listed, that entrepreneurial drive, I see some kind of an atrophy across the sector, and the companies become, so to say, more managerial as opposed to being entrepreneurial. As against that, you see listed space, which has companies anywhere between, say, 100 to 400 crore turnover. That space is abuzz with activity. There are lots of players in that space. And to them, as the cost of distribution goes down, as the cost of consumer reach and acquisition goes down because of Reliance, I feel they will be the ones who will gain a lot. So if you take a sector view, This is a great development. If you take the listed space, this is something which they have to sit down, watch in their strategy rooms and develop their approaches. I have a feeling that Reliance may actually end up promoting, supporting, investing in some of these unlisted FMCG entities and growing in the process by themselves. So I see it as a good development as a consumer, certainly. There would be definitely a pricing benefit. I also feel that the future group operations, which have been in some kind of a turmoil over the past 2-3 years, once they are set right by Reliance, I see even that benefiting the consumer companies, because the entire distribution of Reliance, if it is streamlined and organized, it will create a lower working capital for FMCG companies. The return on investment will surely go up. And I think the sector will continue to run good and high valuations. That's my theory.
Sure. Talking about valuations, Manoj, how do you see things evolving in the FMCG space? Will we be seeing some corrections, given the kind of consolidation that we're already beginning to see and will continue to see?
Before you just comment on valuation, I just want to make a small point, actually. See, whenever, we talk about modern trade, whenever we talk about e-commerce, it is actually seen mostly through the lens of disruption for FMCG. But, the reality is that if you look at, let's say, a large market like US, how it has evolved, because, modern trade is very large in that market. The evolution has probably started 50, 60 years back. What we've actually seen is, let's say, take the case study of Walmart and Procter & Gamble. 1/3 of Procter & Gamble's US revenue comes from one customer, which is Walmart. 15% of their overall revenue, probably comes from this one customer, right? I mean, globally. So, but the big picture, what we have observed is that because of the premiumization benefits, because of the, actually, in fact, they actually get a better shelf space, because of the supply chain configuration integration, because of data sharing, particularly on the front end, what the consumer is doing. P&G, in our understanding, probably have about a higher margin through this channel than, the rest of what they actually get. So it's not necessarily a threat, actually. It's actually an opportunity as well for the well-run large players, actually. So that's point number one. See, valuations, that's the most trickiest part as an analyst, what we have been actually facing, at least in the last 5-6 years, because we are probably in times in which the respect for cost of capital is very low. And for any valuation metric, it's extremely important, to have an understanding on what is your cost of capital is. So to that extent, what really matters at this point in time is the narrative. What really matters is the earnings growth. So we are reasonably sanguine on valuations. We do not really see any material correction on FMCG.
All right, gentlemen, we'll leave it there. Thanks so much for joining us.